Hello everyone, I'm Gregory Schnazy and let's talk about Bitcoin Borrow Die. As always, these videos are not financial or tax advice. Bitcoin Borrow Die is a strategy where we buy Bitcoin, a rapidly appreciating asset. We borrow fiat against it, which is non-taxable event. And then when we pass on, our inheritors can inherit our assets at a stepped up cost basis. This is the overall strategy. I've covered this in our previous videos, so feel free to go back and look at them. Today's topic is compounding growth. So I want to walk you through a spreadsheet that I created today, where we're looking at Bitcoin versus the S&P 500 versus cash over 20 years. So what would happen if we invested $1,000 in Bitcoin, the S&P 500, or left it in cash over this time period? So for Bitcoin, we're going to assume a 29% growth rate. S&P 500 is 14% and cash is negative 6%. The Bitcoin figures come from Michael Saylor's Bitcoin 24 model, which I'll touch on at the end. S&P 500, this is the last 10-year CAGR. And then for cash, this is basically inflation plus debasement. And we're going to look at this over a 20-year period. So if we start with Bitcoin growing at 29% over 20 years, we end at $126,000. And then we would grow the S&P 500 to $12,000, and the cash would go down to about $309. So let's put this into charts and kind of walk through each one. So this first chart just shows the 20-year growth of all three assets. Cash is in this kind of gold color here, and you can hardly see it because it starts at $1,000 and then just goes down. We can see a little bit here from the S&P 500, and then clearly Bitcoin is just dominating in blue here. So this is exactly what we would expect looking at these different CAGRs over a long time period. So some things to point out is just how relatively close everything is. I mean, basically to like 2032, give or take. I mean, they start to diverge, but all the growth, so much growth in compounding interest and compounding growth happens towards the tail end. These are just huge numbers in the last 5 years, the 20-year period. So since cash barely even registers on this chart, I broke out cash into its chart on its own here, where we'd start at $1,000 and then it just declines over time from interest and debasement. So then trying to put this other concept into a chart to really try to wrap our head around compounding growth and how much of it comes at the end. In this chart here, we're looking at the first 10 years versus the last 3 years. So 10 years over here, 3 years over here. When we start at year one, we'd have $1,000, and after 10 years, we'd grow it to $9,000. And this is about 7% of our total returns in 10 years. So it's 50% of the time, and we're getting 7% of our growth. That means the vast majority of the growth is coming in the later years. So this is over a 10-year, decade-long period. And then comparing just the last 3 years, we would gain $67,000, and it's about 53% of our total return. So over half of the return is coming in the last 3 years. So going back over here, this is where we can just see these 3 years are just so big because our value from $1,000 has finally grown into something. And then when we generate 29% on that, 29% on that again, 29% on that in the last year, you can just see these numbers really spike up. But it's kind of crazy that these last 3 years generate over 50% of a 20-year period. And then breaking this down by year, we can look at it here where we have all of our years and what percentage is returned of the total by year. So like year 8, when we're 8 years in, that year is going to return about 1.1% of our total. And then year 9 is like 1.4, year 10 is about 2%. That's 10 years in. And then 5 years after that, okay, now we're getting to like 6.3% in year 15. So from year 10 to year 15, that's more than 3x. And then year 16 is about 8%. And then it kind of keeps going on like this, where all of these years, like right after year 13, give or take, each slice just becomes bigger and bigger and bigger because the value we've accrued from all the previous years is still growing at 29%. And then we look at year 20, from year 19 to year 20, basically a quarter of the returns, a little bit less, come in 1 year. So it's like these last 3 years, again, generate about like 53% of our returns, which we see up here. So this is, I mean, the concept of don't time them. It's not timing the market. It's time in market, where you just have to hold for really long periods of time to experience this growth. But like so much of the value comes in the backside here. This is just mind blowing. And then I want to walk through the Bitcoin 24 model real quick, just to highlight kind of this net asset versus BTC, where with their net asset again, so it's a very similar curve that we were just showing. The years towards the end just generate so much more value because it's already accrued that value over time, and then it's still growing at 29%. But the reason for showing this chart I wanted to show is when you look at BTC. So in these earlier years, we can kind of see that there's a little bit of a curve to this line where we're adding to our stack meaningfully in BTC terms, right? Going from like 11.5 to 12 to 13. This is adding full coins. That's a lot of Bitcoin. That's a lot of value. And then looking at it down here, we're not really seeing all that much. But then as time goes by, we really see it increase in terms of fiat. But in Bitcoin terms, it's basically flat. And this is one of the really interesting parts about Bitcoin and just such an appreciating asset. It's just so much harder to acquire Bitcoin in Bitcoin terms year over year because the price just runs away from you. Like, I mean, back in the day, you know, people could buy Bitcoins at a time, like an individual could. And then now it's just, you know, so much harder at around like 110,000, 200,000, so much worse, 500,000, so much worse. In terms of like adding Bitcoin in Bitcoin terms, just piling on fiat. But it's just kind of amazing to see how explosive it is in terms of fiat. And then in Bitcoin terms, it's just a total grind. So I just kind of wanted to walk everyone through compounding interest, how back-weighted it is and how hard it is to appreciate that, and really to focus on time in the market. Buy Bitcoin, hold Bitcoin, and you can see how the numbers work for you. So that's all for today. We'll cover more in the next video.